Welcome to Introduction to Trading Session 5. My name is Raman Gill, and I'm founder of the website tradingwithvenus.com. In today's session, we'll take a look at the different currency pairs that you can trade. We'll also take a look at the price charts and Japanese candlesticks and the role that they play in Forex trading. And most importantly, we'll take a look at how to make money in Forex trading. I will also share with you a simple and very profitable trading strategy that you can implement right away. Before we dive in, just a quick disclaimer. This is for educational purposes only. If you have questions about your individual investing needs, I recommend talking to your investment advisor. All right, let's dive in. Let's take a look at some of the major currencies that get traded in the Forex market. The first one and the most important currency that gets traded is the US dollar, which is represented by the symbol USD. There's also Euro, represented by the symbol EUR, British Pound, also known as GBP, Japanese Yen, called JPY, Switzerland Franc, CHF, Canadian Dollar, CAD or CAD, Australian Dollar, which is called Aussie or AUD, and New Zealand Dollar, which is NZD. When you trade currency, you always have a pair. For example, we have Euro, US dollar. You're never selling one currency. You're always selling a currency against another currency. And by that, I mean, for example, let's say you're buying Euro, which means you're selling US dollar. Or let's say you're buying Pound, which means you're selling US dollar. Or something else against that. There's always a pair of currencies that you're trading. You have to buy one currency and sell the other currency simultaneously. And that's how we place trades in this market. There are a lot of different crosses. Some of the main ones are called dollar crosses because dollar is the most dominant currency in the Forex market in this world. Most of the trade gets done in US dollars. So a lot of times you are trading US dollar against a different currency. In this case, all these pairs have US dollar in them. So we see GBP US dollar, which is British Pound against US dollar. We have USD, JPY, US dollar against Japanese Yen. Then we have AUD, US dollar, which is Australian dollar against the US dollar. So you would always be selling or buying one currency against the other. Now, the pairs that do not have US dollar in them are called cross pairs. In this case, these are the Euro crosses, which means we have Euro and we have a different currency against the Euro. In this case, we have EUR CHF, which means Euro Swiss franc. Then we have Euro Pound, Euro Canadian Dollar, Euro Australian Dollar, Euro New Zealand Dollar. And you can have different crosses here. These currencies here can, on both sides here, can change. It is up to you to decide which currency you want to trade. Most of the US crosses have a lower spread, which means it costs you less to trade them. And the reason behind that is because US dollar is the most traded currency, and because there is so much supply of that, and there is so much liquidity in the market around the US dollar, it is easier to trade. And anytime you're trading a dollar cross, the spreads you'll get would usually be better than when you're trading a cross pair. So as we just talked about, US dollar is the most traded currency. As you can see here, US dollar takes up 84.9, 85% of one side of the pair. So it is, most of the currencies are quoted against the US dollar, just like we talked about. In fact, 85% of them are quoted against the US dollar, and this is, as you can see, this is how much it gets traded. And then next, after that, you have Euro with 40%, and then Japanese Yen and British Pound, and so forth. And everything else beside these, everything else combined is 25%. That's why when you're trading US dollar against another currency, it is cheaper or more cost effective to do so. Forex price chart. When you're trading Forex in the market, we look at price chart. We are looking at these things that are called candlesticks. These little bars here are called candlestick. This is called a candlestick price chart. And we look at these candlestick patterns to determine what the price is doing in the market. Let's take a deeper look at the candlesticks. The reason this is called candlestick is because the picture here, the image here, looks like a candlestick. We have a body, then we have a wick. Now the difference between a real candlestick and a Forex candlestick is that there could be wicks on both sides of a candlestick. Most of our candles that we use at home only have wick on one side that you light. However, in Forex, you can have wicks on both sides of the candles. So in the middle, you have the candle body, and then you have wick on either side of the candle. Now, this is called a bullish candle, which means in this case, the price went up. So the price opened at this point, and then at some point, it traded down here and formed a low, and then moved up and formed a high at some point, but then came back and closed at this point. So here's the open, this is the close, and then it went and formed this wick, it's the high, then retraced from that level and came back to close right here. Also, during the session at some point, it formed this low here, and that's your candlestick. This is a bullish candlestick because in this case, the price went up, the close is higher than the open. Now this here is called a bearish candlestick, which means the price opened here and it closed here. At some point during this candlestick, we had price go up and test this high. It got rejected, wasn't able to hold there, then came and tested the low at some point, got rejected there as well, and closed at this price. So when the price opens higher and closes lower, that's called a bearish candlestick. Now, how do you make money trading Forex? So first thing you have to do is you can buy a currency. For example, you can buy euro against the US dollar. So it'd be buying the euro and selling the US dollar. And let's say the euros go up in price, and then you decide to sell the euros and buy back the US dollar. In that case, during this transaction, because you bought at a lower price, price went up, and then you sold it, you would earn a profit. We can make profit doing it the other way as well. You can actually sell a currency, and if the price goes down, then you can buy that currency back and make profit as well. So there is no restriction in Forex that says that you have to only buy, hold, and then sell high to make money. You can actually sell, price drops lower, and you can close out your trade by buying that currency, and you can earn a profit, which means you can trade on both sides of the market. You can make money when the price is going up, and you can make money when the price is going down as well. So there's a lot of flexibility in trading this market. Now let's take a look at a strategy that is very effective and can make you money. This particular strategy is called trading the range-bound market. So as you can see here, the price is holding within this range. So we have a high here, and then we have a low. So every time the price comes to this level, it's not able to go lower. So this is the lowest level that the price has come to, and then it gets pushed back up. Every time the price comes to this level, it gets pushed back up. As you can see, 4 times the price came to this level and it got pushed back up. And then this level would then be called support. And this top level here is called resistance. Every time the price goes to this area, it gets pushed down. So this is the resistance area where the price is not able to break through. And as you can see, again, the price comes to this level, it gets forced down, it gets pushed down, and it's not able to hold any higher. This kind of market is called a range-bound market, because the price is trading within the range. It's trading between this low and this high. So this is a range the price is trading in. It's not able to go higher or lower. So the price keeps bouncing back and forth within this range. This type of market is also called consolidating market, and the trend is called sideways trend, because it's not going up and it's not going down. It's just holding steady between these two lines. Now let's take a look at how would you trade this type of market. The first step that we need to do is we need to identify that the market is in fact in a range. So you need to be able to draw the support and resistance line. If you can identify few different areas where the price has traded at the same point, that will be your support area. You would draw a line through there, and then you would identify your resistance where the price keeps getting pushed down from. So you identify your support and your resistance area. Once you see this type of a movement, you know it's a range-bound market. So make sure you do not have a bias in the market. You're not biased either to buying or selling. You're flexible. You're ready to both buy and sell in this kind of a market. Most important thing to remember about this is that at some point the price will break through. It will either break through to the bottom or it will break through to the top. So you have to make sure when we trade a range-bound market, make sure that you have a stop when you place your trade. It is always recommended that anytime you enter an order in, you have a stop loss and a take profit areas marked right off the bat. You put your order in and also mark your stop loss and your take profit at the same time when you enter in your order. This way, you're protected in case the price goes against you, you take a small loss and you step outside of the market. However, if the price does go in your favor, you have your take profit area marked and you don't need to close the trade. It will automatically get closed when the price gets to that area. So you're not forced to sit and watch the charts. You can place your order and walk away. So it's really simple. Now let's take a look at the chart itself. So this is what you will see in your trading platform. When you open your charts and it's a range-bound market, you will see this kind of price behavior. You'll see an area where the price keeps pushing into, but it's not able to hold above. We see wicks in this area, so the candlestick wicks have formed in this area. However, the price never moves above this blue line that you can see. And as you can see at the bottom here, price is not really able to break through this first blue line. It did once. There was a long wick, however, it came and closed in here again. And the next time it tried to go below, it wasn't able to go below. So this is a range-bound market because the price is just going back and forth between these two lines. All right, so how do we trade this market? As we can see, this is the resistance line we have identified. So we draw a line here, we connect different wicks here and draw a line through here. So every time the price comes here, we want to sell. So we can either have a pending order placed or we can watch price action as the price comes into this place. And once the price doesn't hold above this line, we just take a sell trade, expect the price to go down, and as the price comes down, we have our take profit entered, we close our trade to take the profit. But we are expecting the price to come down to the bottom. When the price gets to the bottom here, we are looking to buy. As the price gets closer, we can either have a pending order that would get executed as soon as the price hits this area, or you can wait and watch the price action to see that the price is not going below this level, and then you can manually enter your trade. Your stop loss needs to be below the previous low. So in this case, your stop loss will be right here. As the price is coming down, you're looking to buy, and then your stop loss needs to be below the previous low. So in this case, as we can see, the trade would work out beautifully. Price never gets below there. It gets rejected right at the bottom of the range and it moves up. And as the price approaches this line, you are looking for an opportunity to sell. So you can have a pending order selling at this price, and then you need to have a stop at this level so that you're protected in your trade. So that if something were to go wrong, if the price keeps going to the wrong side, you will get taken out of your trade with a small loss. However, you won't lose your entire account. You can live to play another day. And it's okay in this market, it is okay to accept losses as long as they are small losses. You have calculated the risk on each loss or each trade. And one of the things that you want to remember is your risk to reward ratio. I recommend having a risk to reward ratio of 2-to-1 or 3-to-1, which means for every single pip or point that you're risking, you are making 2 to 3 times the amount in profit. In that case, let's say your risk to reward ratio was 2-to-1, so which means if you're risking $200, you're making $400. In that case, even if you lost 50% of your trades, you will still be profitable because for each dollar lost, you're making $2 in return. So even with losing half your trades, you will still be profitable. So that's all we have for today. We took a look at the candlesticks, we looked at the charts, we discussed a strategy, a simple strategy that can make you money right away. So again, thank you very much for joining me today. If you have any questions for me or you would like a strategy session with me, which is a free one-on-one strategy session, please email me at raman@tradingwithvenus.com.